Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. It was my pleasure to have another conversation with Ben Rogoff, the manager of Polar Capital Technology. Has been the manager or been involved in management there for nearly 20 years now, and the trust itself has been going for nearly 30 years. I can remember when it started a long time ago. Anyway, Ben, we were going to talk back in January, I think it was, but that got postponed because of a certain event that took place. We might as well start there. I think it rather threw a bit of a potential bomb into the whole technology AI story. But of course, we've moved on since then. And that story was the announcement by DeepSeek that it had apparently or allegedly found a cheaper way of doing what Nvidia had been doing, and therefore perhaps undermining the story of the whole Nvidia remarkable performance over the last few years. When that news dropped, what was your initial reaction? And then we can go on to talk about how it's actually panned out since then.
So obviously we were due to chat then, weren't we? And obviously we've had to delay because of said DeepSeek. And yes, it was a bit of a bombshell, and I think it wiped $1 trillion or some crazy number off market cap that day. My colleague Nick and I and some senior team members spent the Sunday discussing a plan, and we made the decision to take some money off of the table. Principally because, and I think this is a theme that's going to continue to resonate through this AI cycle, which is that we're at the early point of a technology cycle where people's knowledge and the pace of innovation are not necessarily attuned to one another. There's just an awful lot happening within AI, and we're learning on the job. And that's said, hopefully from a position of domain expertise. We're tech investors, but we had to very quickly get up to speed with some of the innovations that DeepSeek introduced, had to understand some of the key debates. And I think that the stock markets typically shoot first and ask questions later. And I think that in the end, we think about ourselves as stewards of other people's capital. And I think until you've done the work, it's prudent to take some money off. And again, I'm talking at the margin rather than core positioning of our portfolios. But DeepSeek was new news. The headline announcements were pretty shocking. $6 million to do something that others are spending billions on, allegedly. And I think actually, like the market, we did more work and actually felt much more comfortable that what DeepSeek were solving for was very interesting, but not quite the same thing that Sam Altman and others are trying to solve for in their versions of AI. And we can get as deep into that as you're interested in. But I expect a lot more of those episodes. And I think that it's important for your listeners to understand that. If you look back to that incredible period in the mid-90s when the internet really was born, I mean, many of us had used it before, but nonetheless, commercially, from a stock market perspective, 95 through 98 was an incredible period for NASDAQ. I think it was up more than 3.5 times. And that's before the last sort of craze.com melt up. And again, this is not investment advice, and it doesn't mean that history is going to play out again. But during that period where the NASDAQ rose 3.5 times, we had, I think, 15% corrections. And some of those corrections were macro, Trump-like, and some of them were very much to do with the technology at the time, which, of course, was the internet. And I just think what we just had, that DeepSeek episode, may be, in hindsight, best understood as one of those 90s episodes where our comfort and confidence collectively are shaken by new news. But I'm reasonably comfortable now with where we are at, and we've rebuilt much of our exposure. Let's go into that shortly, I guess.
Yeah. Well, perhaps you could just try and explain to us lay persons exactly what those sort of layers that you were talking about and the difference between OpenAI and DeepSeek. So without getting too far into the weeds, if we can, what is it they have done that is genuinely kind of different? And what is it that is not quite the same as what
I think
OpenAI
the starting point is that the headline number was a little bit like trying to, I think they said $6 million to build the model, but what they were really referring to was the last run. Before we get into the model stuff and the AI nitty gritty, it would be a little bit like, I don't know, estimating the cost of making a cup of tea with reference to the time you put the kettle on, rather than costing up the kettle, the infrastructure, the electricity, the water, and all the other stuff that you needed before you click the button on the kettle. And our best estimates, or certainly other people's estimates, are that maybe the infrastructure that DeepSeek have put in place is maybe worth $1 billion. Maybe $1 billion plus. This isn't a $6 million effort. This is $1 billion effort. Some of the other headline sort of sticker shock were around the cost of each time you use the model. So we call that inference costs. And that, again, was a pretty scary number. But actually, if you look at the cost curves that we're on, again, you'll know this, that the cost of carrying internet traffic in the 90s was falling precipitously. Obviously, volumes were going up a lot, and that was okay. And that actually is a prerequisite for technology adoption, is rapid price declines. At the headline level, DeepSeek talking, I don't know, I even forgot the numbers, thankfully, but just incredible cost downs of their model relative. But when you listen to actually 48 hours, 72 hours later, the comments from people like Sam Altman and others that were very complimentary, actually, about the DeepSeek progress. Actually, Microsoft talked about the fact that each model generation is 10 times cheaper anyway. That when you actually step back, the sticker shock was really a sticker shock about the cost curves that were in existence already. So what did they do? They built a model using some incredibly innovative, the way my colleague describes it is a lot of innovation. For the petrol heads that listen to your podcast, we've likened it to I think the Nissan GTR that in the early 2000s came out with a car that had sort of supercar performance at the cost of a not quite everyday car, but certainly not supercar price. And in time, what happens is a lot of those innovations around superchargers and I don't know what it would have been at the time, four-wheel drive and some very clever things that they did were ultimately absorbed and used by all car makers. And just to follow the parallel through, Ferrari's doing just fine. So the way my colleague describes it is 80% of the innovations that DeepSeek used. And by the way, those innovations were almost forced upon them because they're unable to access the latest Nvidia chips because of earlier export control. So I suppose this is the mother of invention, really, isn't it? And the need to make do with older chips has ended up with some pretty impressive tinkering under the hood. 80% we think of those innovations can be used by others. 20% look quite unique to the way that DeepSeek is doing AI. But just to, again, if I may, step back, the DeepSeek model, if you're trying to use AI to, I don't know, perhaps write a first draft of a letter or take an image and be able to identify what that image is, the DeepSeek model is absolutely fine. I mean, it's actually better than fine. It's very good. That, on the surface, looks like a real threat to companies that are spending billions of dollars like OpenAI or Anthropic, Microsoft, Google, obviously. The thing is, though, that the models like Gemini at Google or ChatGPT or various versions of that, those models we describe as multimodal. And the very clever innovations that DeepSeek's introduced are not multimodal. If you want your model to be able to not just work with one mode of information like text, image, or audio, and in fact, you want that model to be able to do all of those things at the same time with very limited time lags, then the DeepSeek model, in our understanding, will not work. It will not do. So in our view, it sort of addresses this sort of elephant in the AI room, which is that there are lots of companies ostensibly running the same race. It's a bit like the London Marathon. You know, there are thousands of runners, but probably only 40 that are actually going to win it. There's the elite athletes and there's everybody else. And our view on this, and perhaps we'll be proven wrong in time, I hope not, is that many of these cheaper models are really not playing for the big prize. And the big prize, if you're Sam Altman, is artificial general intelligence. If you're going to ultimately build arrays of compute that can reach human and superhuman capabilities, then they're going to have to be able to cross the road, aren't they? And they're going to have to be able to do multimodality like humans do. So I think, again, easy to feel confident after a rebound in markets and a recovery in some of the share prices, perhaps. But I think this is likely to happen again, which is that innovations will happen, challenge assumptions. And like we saw with the 90s, ultimately the truth will out. And our sense is that the DeepSeek model has probably accelerated the timeline to a broader adoption of AI, which in the end is good and shouldn't have too much of an impact on the spending, which is really what matters to Nvidia, of course, is how much capital spending is happening around the AI theme. Shouldn't impact them because the hyperscalers, those very big internet companies and others like Elon Musk with XAI, are trying to solve for something different.
Right. So it's a lesser thing in a way, and that it's a more narrowly focused thing.
Yes, that would have been a much more succinct way for me to describe it. Yes, absolutely that. Still a very impressive thing, by the way.
Yeah. And presumably there will be others like DeepSeek coming along and chipping away at other areas of this whole development.
Yes, absolutely. And I mean, there already are. Of course, Alibaba has its own models, Xiaomi in China. There's a slew of Chinese companies. I think that's one of the things that added to that January day, wasn't it? It wasn't just that it was a cheaper, and it is a cheaper, just to be clear, cheaper, successful model. It came from China. And of course, that wasn't expected. The gap between the US AI labs and the Chinese AI labs just closed. Not entirely, but the gap between them closed. And that conjures up images of the 60s and the space race, and then what happens, and will there be export bans? And some of the VC industry in the US are calling for export ban. So it wasn't just the model, it's that it raised the spectre of a much less benign environment for the overall AI capital spending. So now, of course, anyone who remembers or has read about the history of the space race will know that's not how it has to play out. The US spent nothing of GDP on space in the mid-50s, and before the moon landings, they were spending 4.5% of GDP. So this could work very well in the favor of companies providing capital equipment if we go down a space race route. I think in the end, like we've seen all year in stock markets, we've just had a wider range of outcomes. And typically that creates volatility, and it creates much wider, bull and bear base outcomes that creates volatility that in the end isn't a very pleasant feeling for investors.
Right. Of course, you always say when you start out investing in tech that it's going to be volatile, more volatile than other sectors. And it certainly has. I mean, I'm looking here, the share prices peaked around 380 or something like that, I think back in early January on the post-Trump euphoria type thinking. And then it fell all the way down to, well, I'm talking about your share price here, I should say,
Sure.
not Nvidia, to around 260 or something like that. So that is quite a big reversion. Obviously, it's bounced back now to around £3.
We had also just, of course, come out of the Trump win and a very strong end to the year. A good January as well, lots of excitement around AI, and then, thwacked by the DeepSeek news. But you're right, the drawdown in itself was a very significant one. And like you say, it's not my place to give investment advice. I'm hoping that your listeners get that from somewhere very sensible. But again, having the right amount of exposure, but also the right investment time frame has been critical to getting tech right, because it's very easy to get shaken out of a sector that has more volatility than others. And that must be true. Well, again, I'm hopefully communicating that today if I haven't already, which is that early in new technology cycles, and we believe very strongly, by the way, that the AI story isn't just another theme within tech, but actually it represents a brand new investment cycle for the industry for reasons that we can go into if you're interested or not. We're 3 years in, and we're at that point of sort of rapid innovation, but also the extrapolation of almost every data point. And will Microsoft cancel a power contract in Cologne or somewhere is having a massive impact on all of the share prices of companies that don't even know that Microsoft had a power contract in Cologne. And that's what happens when you're early, because you're extrapolating data points out many years in order to understand whether or not your thesis is correct. I'm not talking about us here, I'm talking about the market.
Yeah. And of course, it all happened, as you say, against a broader market background in which there was a lot of enthusiasm, bullishness anyway, and investors wanting to believe, or perhaps riding the wave anyway, let's put it that way. Let's be charitable. They're riding the wave, and things are quite expensive and so on. We all know that was going on at the same time. So just to zero them back down to what that means for what you're investing in. So Nvidia obviously has been a spectacular performer, and you've been, I think, slightly underweight because you can't keep up with the weighting that the market's given it. So what have you done since January? You've obviously worked out that it's not the end of the world.
I think is the answer. Again, if you go back to that 95 through 98, just to give everybody some context, we have a large exposure to companies that lots of people know. Perhaps 55% of our portfolios could be explained by the benchmark if you looked at it that way. Our big positioning, Alphabet, Google, but also Meta and Microsoft and others. But of course, below the surface, we're active. There's 11 people in our team, and we are looking for the best opportunities at any given moment in time. And we're in a live market. So we're active most days. We're doing, I think, between us about 1,000 company meetings a year. So this is a team working hard, looking for best opportunities. And when you have these moments in markets where cross correlations are off the charts, where everything is acting the same, you get a chance to recalibrate your portfolios. And that's absolutely what we have been doing in this market. And also going back to that 95 through 98 parallel that I mentioned, even though the tech market sort of motors on through that period, the leadership changes. And I think that that's, again, another reason why, in my humble opinion, tech investing is something that you should leave to others. It's not something you should be rifle shooting in as an individual investor because of longevity. And I don't know if you saw this yesterday, Google was down sharply on an announcement that people weren't maybe using Google search as much as they have been on Apple, which came out in a lawsuit that's happening at the moment in the States. And the stock was down a lot. And Google is a name we own. We've owned it since IPO without interruption. And it's a name that we're now meaningfully underweight because it's beginning to feel like the incremental search is happening in an AI chatbot. And I'm blessed with 2 teenage children, and both of them interact with the internet using things like OpenAI's ChatGPT in ways that are alien, perhaps, to I don't know if I say people of our age, but I'm 52, certainly people are 52. We ask questions of the internet. My children interrogate AI chatbots. The point I'm trying to make here is that AI, while it's early in an adoption phase, the technology is continuing to move very powerfully up to the right. And we expect that to continue. But the key takeaway from all of this is that around this market volatility, and it has been mostly market related around Donald Trump, Trump 2 not being quite what Trump 1 did, at least to date. But there has been obviously the DeepSeek stuff too. Around that volatility, our core belief that the AI technology cycle is early and in good shape hasn't changed. And so the rejigging that we're doing is really about what are the best ways to capture that. And so we have perhaps a little less Nvidia than we did before. So we're in the high nines today. Just to be clear, we can go above 10 in the trust, but no more than the index weight, with an absolute maximum of 15. And I think it's fair to say that we as a team are reticent to, I guess we've very rarely had much more than 12 in anything. And I feel like as experts with 100 and something stocks in our portfolio, that extra 1% in Nvidia, we could find a home for it somewhere else. And we've got lots of other ways to get exposure to the AI story. But I guess the punchline is we've been reducing Google. That feels to us like they've got some incredible tech, but that when you look at the usage of ChatGPT and some of the traffic trends, people's behavior changes before monetization. And so we still love the business. We've owned it forever, but we've been reducing that one. We've been reducing Amazon, which is now down to one of our slimmest weights for many years. And again, I think there's some tariff risk. There's advertising risk. That's a macro risk, really, rather than anything else. But the likes of Meta and Amazon, while they're US businesses with very limited exposure directly to China, they are recipients of inbound traffic from Chinese e-commerce companies. So we made some adjustments there. We've been reducing software, Jonathan, quite a lot. We think that a lot of people involved in the technology industry have been brought up really to love software companies. They've got some of the best unit economics of any companies on earth. We think that there are some outstanding software companies that we want exposure to, but more broadly, we worry a little that the packaged software industry and this idea of being a tool to knowledge workers feels a bit at odds with a new general purpose technology, AI, that is designed to ultimately, yes, start by complementing, but ultimately substituting for human labor. So broadly speaking, we describe ourselves as AI maximalists. That hasn't changed. We skew towards the capital spending side of the equation because we still feel there's a lot of skepticism in the market around the sustainability of that capex. But we've just come through earnings season. All the major companies have had a chance to cut their spending. And that's after DeepSeek. That's after this macro uncertainty, and none has. And in fact, Meta raised its capex. So to us, it feels like the race is on, and we want to be maximally exposed to that if we can.
So this is more picks and shovels in a way, is it?
It is. It's very much picks and shovels. And I guess I'm certainly reticent to use that phrase because we know how that ended in the late 90s. But we look back at, say, railroads and think about how many years we operated at levels north of 2% of GDP and had some crazy years of 7 or 8% of GDP. And we haven't even had a year yet where we've been above 1% of GDP in AI. So I think what's incredible is, of course, that the numbers are very large. Nvidia's revenues are now very large. But you referenced earlier about valuations. I don't recall this being the case in the mid-90s, but that might just be a case of rose-tinted spectacles. I don't recall leadership stocks like Nvidia. At the time, it would have been Cisco or Sun Microsystems or something, trading as Nvidia is today on 24 or 5 times forward earnings. There is a lot of skepticism around the sustainability of Nvidia's growth. And that may or may not be warranted. I'm not here to give that investment advice. It's just more that when we were at the very end of that 90s infrastructure build, the market was putting peak multiples on peak earnings, and we certainly don't appear to be doing that today.
Yeah, there were much bigger multiples back then, that's for sure. Just on the subject of big stocks, while we're about it, and this is perhaps into tariffs as well, I'd like to get your general feeling about what impact, if any, the tariff regime, if and when we find out exactly what it is going to have on the kind of stocks that you own. Well, let's just take one big example. Let's take Apple, which has obviously been affected by sentiment and indeed perhaps understanding of what the Trump regime is doing. Can you kind of guide us into that issue around tariffs and how it's impacting, if it is at all, on the kind of things that you're investing in?
So I think when you look at the market broadly, the market doesn't believe that these tariffs are ultimately going to be sustained. And I think that it's fair to characterize our position in that camp. I don't think anybody believes that the Chinese tariffs are a real thing, but they're a bargaining chip that's there to be hopefully reduced and so on. And obviously the news today in the UK, although I haven't seen the detail yet, but suggests that there's deals to be done. And I think that that is not an unreasonable assumption. What do tariffs more broadly mean? I mean, they're just bad, aren't they? There's no sugar coating here. But in the end, one of the reasons that the tech sector has done so well, but let's be honest, global equities also, is that we've been living in a world where we've been enjoying the economic benefits of globalization and freer trade and specialization and things that really do depend on as open markets as we can have. And anything that goes against that trend is, I think it's fair to say, has to be perceived as a negative. So I think if we're talking in broad strokes, I think tariffs, wherever they're struck, are unhelpful. But I think that there are levels below which they can be managed. And I think that certainly the companies we're invested in are largely, not all, but many of them are capital light. I think that that's helpful. I think for the ones that are less capital light, like, I don't know, semiconductor manufacturers, let's say, or people that make smartphones like Apple, I think it's harder to move your geographic footprint, but you can. So for Apple, tariffs at the headline level are really to do with how many iPhones do you ship to the US and where are you shipping them from. And I think it's a very meaningful impact to their business at current levels. They're really very meaningful. Again, if we really believed that they were going to persist or land where they've been initially pitched, we would own a lot less Apple. For what it's worth, we've been reducing Apple for reasons, I suppose you could argue, to do with tariffs, but actually it's more to do with the fact that we think that Apple's strategy around AI may be tested. And we can come back to that if you're interested. It's probably more interesting, if I may say, than the tariff question, because we can't really add any value on the tariff story. I mean, Apple will try to move its manufacturing to India. And when it does that, the tariff impacts will be less harshly felt. By then, we'll know if Mr. Trump is serious or not, won't we? So I think, just as a reminder, the tech sector is not just a beneficiary, but it's been one of the engine rooms of globalization. Therefore, we are on the receiving end of tariffs. We're hopeful that they won't be as bad as billed. Obviously, we're fairly fully invested in the trust today. We have a slither of put protection that actually was very useful earlier in the year, and we've banked some of the profits from that. But again, it's a finesse rather than an investment strategy. It's just to take the edge off the portfolio beta when things are tough. So to get back to the point on Apple, I think that in most scenarios, it's a manageable risk. The market has derated the asset a little to reflect that. And the sector, I think, is 55% of sales are international. So in the end, we have been, yes, beneficiaries, but also drivers of globalization. And therefore, it is definitely something that we're very focused on. But again, at this point, we still remain of the view that there'll be a reasonable outcome that most of our companies will be able to work with. And we don't think it derails the story. And I think that really, just to back up a bit, is our starting point on all things macro. Again, we don't profess to be experts. We write strategy papers. We obviously have a view about recession risk and so on. But really what's most important from our perspective is the macro environment conducive to markets and to tech company earnings, and specifically the AI imperative. And so far, at least, earnings season that we've seen so far in Q1 has been better than expected. Clearly, tariffs are featuring in people's guidance, and some companies reluctant to give you guidance, understandably. But I think that most of the companies that we follow and most of our investments, I suppose, have broadcast a view similar to our own, which is that we feel that things will ultimately resolve reasonably. And that today is our base case.
I guess one point one could make is that the reason that Trump and the tariff thing has happened at all is because maybe globalization has happened too quickly and too fast, in the sense that it's created political dynamics, sections of the population that haven't benefited as much from it as others, if you put it that way, in your Rust Belt and so on. And those political pressures aren't going to disappear either, are they? So to that extent, there may be a cloud still out there somewhere, which is...
I think that we are probably living in slightly less certain times. And I think you see that in political polarization, not just in the US, but in many places. You know, Germany not being able to get the chancellor sworn in, and the UK reform in the recent polls. And again, not passing political judgment here, but more just observing. And I think that this sort of erosion of the political centre is not something that happened overnight. So I think we have to live with that as investors. I still believe that our interests are relatively well aligned with policymakers. This episode around tariffs and Trump feels a little reminiscent of long-term capital management in the late 90s, where, again, that may sound a bit bizarre, given that one was about leverage and hedge funds and what have you, but ultimately it feels to us like this situation, and of course the probability of a recession is now elevated. again, that creates that sort of slightly more volatile backdrop. And where will earnings come out in 25 and 26 is much harder to say when you're worrying about the potential for a recession. But I think, like that earlier 90s episode, actually, it remains in the power of policymakers to get this back in the lamp. Mr. Trump can decide to do deals. This can be put behind it. His popularity is not looking great. He has midterms to win. There's a budget to be passed. There are some very sensible reasons why we are, and I hope we don't end up looking overly sanguine about this, and we're not being complacent, but I think it's not unreasonable to believe that he and the Republican Party will want to get deals done. And I think the same could be applied to the Chinese, where there is incentive there to get things done before companies start potentially moving manufacturing to other geographies. And they have a domestic economy to support and so on. But to your point, it is possible that we'll look back in 5 years and say, gosh, wasn't that earlier period great when we lived in a, I don't know, disinflationary period where politics and economics were unusually aligned. But I don't know, we've both been doing this a long time, and this is an industry that tends to over-index the sort of negatives, and certainly my experience of markets, and there's been lots of volatile episodes, but this idea that ultimately the technology sector has been able to outgrow the broader market. Yes, there's issues with the tech sector around that volatility, but also corporate longevity and some of those intrinsic differences around tech investing, they're not going away. But do I still believe that the backdrop is conducive to companies on the right side of the AI story being able to deliver strong growth? We feel pretty confident in that.
You are listening to our Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Can I ask you what the reaction of your shareholders or fund holders has been? Obviously, you run an open-ended fund as well. In terms of either qualitative contact with your shareholders or quantitative fund flows, what's been the impact so far of this rather interesting period we've just been through, starting from...
That's a really, really good question, and I'm rarely asked it, and I'm not sure how to answer it fully, but look, you know me for a very long time. I take nothing for granted. I feel blessed that I've had a long career in one of the best bits of investing in the UK, and delighted to have been able to help people, hopefully make reasonable money over time. But I'm very hair shirt. I have a horrible fear of missing out, and I do wear the ups and downs still. So with that in mind, I was marketing recently for one of our wealth manager clients. There's lots of faces I've known for many, many years. And the first thing I do is to apologize for the recent volatility, because the drawdown is, as you pointed out, quite a meaningful one. And again, I hope this doesn't sound overly complacent, but I think it really reflects the fact that I think the investors understand it. And they understand that the volatility is part and parcel of investing in a single theme like tech. And honestly, I had people telling me off for being a bit too hair shirt around, sorry for the drawdown. For many people, PCT and other tech funds and trusts have been really great vehicles for them over extended periods of time. And so I think that I've been very pleasantly surprised, but maybe I shouldn't be. Maybe actually there are times where you need to step away from the day-to-days and sort of look back. And the big picture has been a really good one for tech. So the discount is still sort of there where it is and hasn't gone out, but hasn't come in. The company has been buying stock very regularly, doing our bit to try and better equalize supply and demand, but also it's accretive for current holders. So we're doing our bit there. And no, I don't think there's been any real panic. There was panic on the DeepSeek day, not directly related to PCT, but many of the brokers that we talked to said that they had never had more people, never had more people on what does DeepSeek do and what does this do to the AI story. Thousands of people taking down Zoom calls and whatnot because of the amount of people that were obviously impacted by it. But I would say overall, it feels like our investors understand at least the ups and downs that go with tech investing.
So I guess implicit in that is a kind of suggestion on your part that, as you say, we're still early in this cycle, and therefore, provided you get the basic decisions right, the potential for this trust to go on growing around the kind of mean level that it's done over the last 5, 10, 15 years, which is somewhere around 10% at least, sort of double digit, maybe low double digits, that has not been impaired. I wouldn't expect you to say it had been.
Look, I'm as honest as I can be. And again, we don't know is the answer. Do you? You don't know. If tariffs stay at these levels, we're going to have a recession. I don't think there's any question about that, or not going to, but the chance of having a recession will be reasonably high if these tariffs are for real. And again, I don't think that's in anyone's models, because who would take a country into recession out of choice? I mean, maybe if anybody would, Mr. Trump might, but probably not. So there are risks here that we haven't really talked to. There are risks around export controls. What if the model for AI competition between, say, the US and China doesn't follow a pattern of the space race, but follow something more like the Manhattan Project? That might not be entirely conducive for my companies to sell lots of goodies to companies in the UAE or in Israel, or I don't know, wherever it might be. So there are risks. I wanted to just quickly caveat what I'm about to say next, which is those risks are real. And we invest in what we believe to be great companies in a diversified way. I hope people believe us when we say this, but we do it with as little hubris as possible. Ultimately, it's not about having who's got the biggest position in Nvidia or who got it first. This is not important. These are not questions that even cross our minds. What does our portfolio look like at month end? We must look like we don't care about those things. We care about trying to deliver good medium-term returns, risk adjusted. How do you do that? By investing, we believe, in companies that grow. And it's that growth that ultimately manifests as share price performance. Now, the bad news is that if it was that simple, we'd all be doing it. And the reality is there are casualties along the way, which is why you need a diversified portfolio. But when I look at the growth profile of our portfolio today, it is very much commensurate with the growth that we've had in the past. And look, there are risks around AI. We haven't really talked about AI in any sort of depth here, but for us, general purpose technologies like steel, like steam, like electricity, we've talked a bit about this in the past, have incredible impacts on market creation, but they also have a pernicious habit of redistributing profit pools. And it would seem a little bit complacent of us to assume that we didn't have some of those profit pools that others were looking to redistribute. So I think you have to be very alive to this. And in the same way that Intel is a great company, but has not been a good conduit, really, as a semiconductor investment for at least 10 years, because a lot of the growth that we've seen in infrastructure has been in white label, non-branded IT. You can buy AMD chips, or you can build your own chips, or you can buy Nvidia chips now for AI. So that model of Intel being the best company to discuss to becoming a less good conduit feels to us like a template that will apply again. And so it's absolutely contingent on us to make sure that we don't overstay our welcome in companies that might fall into that mode. Because great companies don't go to zero overnight. But what happens is they become less good conduits for the things that you're excited about. And when I look at AI, we're excited. And again, I don't know how much I can soapbox you at this point, but the models keep getting better. The adoption is rapid. I think OpenAI has 700 million weekly users now. When you look at web traffic, I think this is what spooked Google yesterday, which is these may not be searches that you're selling advertising against. But yesterday, my son and I used OpenAI's O3 model. We haven't talked about
You're going to come on to that, yeah.
models, but we used this model to help him make selections for preferred colleges at Durham University. Now, that's something we would have done before with Google or talking to friends. We did those things too, but we also set a very interesting question for this O3 model, gave it the parameters, gave it a really good prompt, the question that you ask, and it took nearly 11 minutes to come back with what it believed was the best places for my son to apply. And we actually took that advice and we used that output. You may have used one of these models for your own needs or wants, whatever, but I'm using it all the time. And we're really still very early in model progress. But I want to give you a stat that's just a great stat. So I'm sure everybody's familiar with Moore's law, the idea that every 18 months, a chip basically got twice as much for your money on the same amount of space as the transistor. And that scaling, which went on for decades and is still kind of continuing as we speak, transformed the world as we know it. The chips that got us to the moon went into our toasters or something similar. That scaling, if you think about the improvement, was something like 1 to 1.5 times a decade. So if you take that improvement and you compound it, you get basically 1.5 times more per decade. If you look at the scaling that we've achieved so far with AI models, the improvement that we're getting in models is something like 5 to 6 times as fast. In fact, Elon Musk has talked about it every year, 10xing. So somewhere between 6 and 10 times improvement in models, AI models per annum. Now, again, the past is not a predictor of the future. We don't know if past performance is a good guide or not. But if that scaling continues, we would expect to continually be surprised by what AI is capable of. And that, of course, is the upside to not just the earnings numbers, but of course, the reach and the scope of what AI can do.
Well, you mentioned O3. I'm not a great expert on these models, but the next great phase, I think, is something called Agentic AI. And that is a further development, which is basically when this is getting very close to what I would call real intelligence, if you like. What is it and where does it fit into the grand scheme of things at the moment?
It's an incredibly important waypoint that I think people are going to be talking about more this year. I mean, they would have been talking about it. They are still talking about it, but DeepSeek and Mr. Trump have taken center stage. So agentic is sort of symptomatic of what I've just discussed, which is that if your AI model is producing a really good first draft, but ultimately making stuff up, then you're going to be very reticent to let it go off and do your shopping for you. If the AI model is proving to be rather good and not making mistakes anymore, and in fact is surpassing your knowledge of what vitamins would be good to eat on a weekly basis, or I don't know what a good meal would look like, or what can I do with the contents of my fridge, then you might be more willing to let that AI act on your behalf. And that's in the end what agentic AI, the promise, and it means different things to different people like it always does. But for us, it's the idea that rather than AI doing bits of a task rather than a job, so I might use it to help me with my first draft of a monthly, but I'm not going to let it write the monthly that I send to our investors. But what if I could? What if I could let a machine say, oh, I know what you do, Ben. This is what you do. You spend 3 days. The team does this. I tell you what, I'll go off to all the data sets that you use and I'll write the monthly for you. How does that sound? And it actually sounds terrific because I really love the investment side of my job more than I enjoy the investment writing side of my job, although I do actually quite enjoy both. The idea of agentic is really this idea that AI becomes capable enough, it becomes sort of autonomous. And given a job to do, can go off and do that job without further instruction. It's an important waypoint. It's what people are talking about. Most of the AI labs are talking about agentic AI. Well, what does it mean to us, just to be very clear? From an investment perspective, it means a lot more compute. And agentic AI is made possible by something that was critical last year, which was this idea of, we call it test time compute, but inference models. And I said O3, didn't I? OpenAI O3. That is an inference model. So just to be very clear, the models that most people use, ChatGPT, which would be GPT 3.5 or 4 or 4.0, are models that have been trained on enormous sets of data, and they kind of either know it or they don't. So when you ask a question, they either know it or they don't. But a new class of model was introduced last year. It actually was OpenAI's O1 model, which everyone I think can use for free now. And what that model did, different to any other, was this idea of saying, if I could take your question and break it down into various parts, I might be able to solve it better. So I've got all the information, but I don't know exactly the way you phrased it. But if I break it down into, I don't know, 50 or 20 or whatever it might be, component parts, I might be able to answer the question. And my goodness, they answer the question better. And I don't know if you've seen some of these statistics, but they're off the charts and literally off the charts. You know, my son is hopefully going off to university to study chemistry. A few years ago, someone had asked me, what should I do? Well, how can I get out of the way of AI? You would have said, well, maths looks like a pretty good place to be. And if you look at some of these crazy benchmarks where you have to be, you know, one of those sort of TFL guys with the foreheads in order to answer the benchmark questions, these models are now solving a quarter of them. I think the International Maths Olympiads, the stat that blew me away, the O1 model that I just referenced is capable of answering 83% of those questions. But the best model on earth before that, the 4.0 model that everybody uses on ChatGPT, is only capable of 13%. We've made this incredible leap by allowing computers to think. And I've got to be careful how I frame that, but spending longer interpreting the question, breaking it down, answering it. And the question that I told you earlier about the Durham universities or the colleges took it, as I said, 11 or 12 minutes.
That's quite long, you think, by comparison.
It is quite long. But I've equally asked it, what would a strategy look like to turn around Manchester United Football Club with reference to turnarounds of other elite football clubs? And if you read the answer, it's staggering. Now, what I guess I'm pointing at here, and to get back to your answer, is the capability of breaking down a question into various component parts and answering it well is a core prerequisite for agentic. Because if I'm going to task a machine with doing a job for me, move my car insurance, I don't need to look at whatever the money supermarket. You do that for me. You know what date the car insurance is up. You know everything. You know my children's age. You know that we got 3 points or something on the line. I'm making it up. I haven't got any points. Go off and find me the best insurance policy is a very prosaic but real example of agentic AI. And I think that why it matters, I want to make one last point on this, if you don't mind, which is that this is sort of a bit like what we've seen in previous periods in history where hand tools are used by agricultural workers to improve the harvest, but they can't compete with, I don't know, McCormick's Reaper or with some of the mechanization that happens later. And this is automating, isn't it? We're going from an idea that AI is something that I can use as a tool to make me more productive as a fund manager, doctor, teacher, lawyer, whatever, to there are parts of my job that can be done entirely by a machine that allow me then to focus on maybe the higher value work that I do as a human being. And I think that what we're really talking about is agentic AI as non-human scaling. Imagine a situation, there's this incredible quote, if I may share it with you. I see if I can remember it, from the CEO of Nvidia, who basically talked about the idea that, in the future, we could be a company of 50,000 employees, but 1 million AI agents. I think they were the numbers. If not, they were even more grandiose. The point I'm trying to make is that how crazy would it be in a world where a company could say, we have a problem, and rather than going off and hiring 10 people to solve that, or we have an opportunity, why don't we apply AI as a on-demand resource? And that's why the agentic story is so critical, because the promise of productivity gains, the promise of, I don't know, abundance, and I'm being slightly ridiculous, but these are phrases that others have used around this idea of super intelligence, in the end require machines to automate function that humans do today, allowing us to do more. And that's why agentic is so critical. It's really the first important waypoint on this idea of non-human scaling.
So it's a bit like hiring McKinsey without the bullshit and the fees.
I'm not going to respond, but look, we're shareholders in this business called Axon. We've been holders in it for a long time. They're the company that makes the Taser non-lethal police weapons, but also on body cameras that you see everywhere now, those yellow body cams. For the last year, they've been able to take that audio data from the camera and automate 80% of a police officer's report.
Yeah, I read that. It's interesting, yeah.
So that's the model, isn't it? Police officers didn't sign up to write reports. Fund managers probably don't enjoy the report writing. There are lots of bits of our jobs that we would love to be able to hand off. Who's mourned not having to be a gas lamp lighter or use the mangle in the garden? So I'm actually very bullish on this for what it means for humankind. I'm actually very bullish on what it means for jobs. Again, no one's really asking for that opinion. You didn't either. But I think the point here is that, I think Keynes talked about this. Very rarely people look at these moments in a kind of half glass full way. They think about the risk, the potential loss of income. And don't get me wrong, there are risks around AI. And one of them, by the way, is the pace of disruption is too fast to manage. That would be not great for society. I suspect it would be pretty good for my stocks first. And I hope that doesn't make me sound too low quality. But I think the point I'm trying to make here is that there are risks. But that's where the kind of key debate line is today around agentic. Agentic as a key stepping stone towards full artificial general intelligence. Now, that debate is something we could do another day. But there are some people that believe it's on top of us, a few years away. I think Sam Altman has talked about a few thousand days or something, or whatever it is. And others still believe it's pipe dream stuff. So the good news there is that that wasn't what people were talking about in the late 90s. It absolutely was around new economy, old economy, you're a loser, this is a winner. But right now, 3-ish years in, there's a healthy debate around whether or not this is simply a stochastic parrot that isn't going to be able to do any of the things that really matter. And a whole bunch of people like me who believe that many of the challenges of the world, can't get a doctor, can't speak to a psychiatrist if you need one, or children that are waiting 3 years to see these things, people that can't afford personal tutors, or whatever those things are, those bottlenecks, so many of those bottlenecks feel to us like they can be, and again, carefully addressed with AI.
Right. Well, this is fascinating. We could go on for a long time talking about all this. I'm afraid we have to bring a close here, but I guess what you're saying is that perhaps unlike the internet, which, as often said, showed up everywhere except in the productivity statistics, it can be different with AI, we hope. And it will also enhance quality of life for many people, provided it's properly regulated.
I think that's the bit that nobody talks about. I think that you can have a big debate around when and how and risks and that stuff. For what it's worth, we are, as I say, AI maximalists. The large majority of PCT today is explained, obviously not just by one stock or by one sector, but by a collection of sub-themes and companies, sectors that together give us what we believe is a pretty good overall exposure to AI. Nothing in the portfolio that we think is on the wrong side of AI, a desire to keep moving as data points present themselves. If Google is a market share loser, and it's a conversation piece at the moment, we'll need to own less. We were unafraid to go to zero in IBM when IBM became uninvestable, and we're not afraid of making those decisions again. We don't have to go too fast. But as I say, I'd leave you that one last idea, which is human beings are not brilliant at nonlinear change. And as I said before, Moore's law was nonlinear change. There was a trend there that compounded and changed everything. The trend that we're on with AI is much more rapid than that. If it continues, we're going to be surprised. But I think it's a nice place to end, which is this idea that that reaper that people added to the back of horses that changed the nature of the harvest, you can reap what you sow, came from that technology. And I think that what's so fascinating about that period is that there was disruption. There would have been a lot of discomfort felt by people working on farms about what their futures look like. But as a result of that technology, there was 6 times more wheat harvested by people than previously. It resulted in a US wheat crop that was 4 times bigger just 20 or 30 years later. And with the exception of the awful Irish famine, actually we had eradicated peacetime famine by the end of the 19th century. And I think that's, for me at least, a nice note. And we're in the investment business. We're here to try and deliver good risk-adjusted returns for our investors. But I'm excited about what AI represents. And I'm also excited about what it might mean for all of us, because I think that we are genuinely not far from a period where AI can move us as a species up to the right.
Well, let's all hope that's the case, and we move on beyond the current preoccupations that people have with perhaps more trivial, mundane things. So that was Ben Rogoff, the manager of Polar Capital Technology, talking to me again this week on the podcast. As interesting as ever. So thank you very much, Ben. Look forward to the next one, which time everything will have changed again, we hope, or progress will be even more rapid.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.